Okay, hello, hello. OK，我们再给多2分钟哈，然后我们就会开始。Okay, so we'll wait for another 2 minutes and then we'll get started for today's session over here. Okay, if you're in, feel free to just type it in the chat. Again, throughout the session, if you have any questions, can utilize the chat, put your questions, and I'll be able to monitor them and answer as well. Okay. 那这边华文的朋友哈本来我们今天的这个分享本来是以华文来主要给大家做讲解的哈那这边主办当局就说，哎，要不要临时改去英文？所以我们就PPT 方面呢，我们是以华文的哈，因为之前就准备好了嘛哈。但是讲解的一个过程当中，我就会主要可能转去英文一下哦。那可能不明白的朋友，如果你们是想发问的话哈，你也可以其实用华文来发问。OK，那我可能看到你的问题，如果是用华文来发问的话呢，我就以华文来讲解了哈。OK，但是整个过程当中我就会讲解的时候我就以英文讲解，但是 PPT 就是华文的啦。OK， alright, yep, so we'll get started. Okay, I was explaining just now that initially this session is actually meant to be conducted in Chinese. Okay, but last minute, the organizer actually requests and see if we can actually do it in English because I think there are some audience that are joining in who would prefer English and couldn't really understand Chinese. So we'll actually do it in English, but the PowerPoint slides over here, the text that you see is actually prepared in Mandarin, right? Okay. So we'll do a little bit of a mix for today's session here, right? Just to cater to both languages. The main explanation as we go through today's session will be done in English. But when there are some of you who are asking questions related, and let's say you ask it in Chinese, then I'll do my best to actually explain it in Chinese. Yeah. Okay. So today's topic is really about today's stream, right? I want to do it in terms where we have a little bit of an education component, and then after that we'll jump into the live market to show you the practical aspect and the application of the methods, right, that we're going to be covering over here. Okay. So there are two components. The first part, I'll do my best to share with you as much as we can in terms of the techniques, the processes, the methods that we use to analyze the market. And then the second portion of today's stream is where we're going to take that and go over to the live market environment and apply it, right? And do a live market analysis for you guys. And of course, if you have any questions, just feel free to type it into the chat, and then I'll be able to answer that. Okay. Good. Okay, so today's topic over here, it's really about the methods on Elliott wave. Okay, we may not have the time to really go everything here, but the focus is very much on the Elliott wave methodology. Okay, how you can actually use this technique to very quickly and efficiently kind of like analyze the market. Okay, and from that determine the direction that you want to focus on, identify certain trade opportunities, and being able to execute your trades confidently, right? So quick one, I'm not sure how many of you here are first time listening and joining into the stream. Okay, some of you are perhaps quite familiar with how I run things. But for those of you who are new, okay, just want to very quickly put it out there. I'm quite active on social media, on Facebook, Instagram. You can search me out. You can look for my full name, Kar Yong, ANGKRYONG. Okay, I do share quite a bit of like content, analysis, trading related stuff on my social medias. Okay, but of course, I also want you to be very very careful because near terms, like in the past 1 or 2 years, there's a lot of fake accounts out there. They would like to actually kind of DM you, right? Directly message you, send you a text, telling you about certain campaign offers or products or services, and then ask you to transfer money over them. Just make sure that you are very, very careful on those, okay, because those are actually not me. They're basically fake accounts using my name, my profile pic out there, okay. So if you encounter one and you just want to be careful and you want to clarify, just always ask a little bit more, right? Usually if it's a fake account, they'll not be able to answer you much. If it's me, I'll just tell you that's not me, right? Okay, so just want to put this out there, especially for newer audience that just join in, maybe not very familiar with my style, how I run things. So I just want to give a warning to everyone. Okay, so let's just straight up dive into today's session over here and the content that we've prepared for you guys. Okay, now for me, I've been using the method on Elliott Wave to approach the market, to analyze the market, to trade the market since somewhere around 2015. Okay, now I've come across many different methods in terms of technical aspect. Okay, and I would say each method, each strategy, each technique has its strengths as well as weaknesses. This includes like Elliott Wave would have its strength, would have its weaknesses, right? And there's no which is the best out there, but every trader has his own or her individual style. And the most important aspect is you want to find out which method fits you as an individual, okay? And the process of that is you naturally would need to equip yourself with various strategies, with various methods, go and understand them, apply them, practice them. And then in that process itself, you'll be able to understand which ones suit you, right? And for me, I took a couple of years to actually explore a lot of different strategies. And in 2015, that's where I kind of figured, okay, Elliott Wave is something that I really can connect with. And since then, I've been using this method a lot, and very actively sharing about how Elliott Wave method can be actually used very effectively. Right? So over here, a lot of traders, when they first hear about Elliott Wave, their first impression is always about how do I count the wave? How do I label it? Right? Where do I start with that 1, 2, 3, 4, 5? Where do I put the ABC? Okay, what is the Fibonacci relationships of all the waves? Right? A lot of traders, when they first come into wanting to learn about Elliott Wave, they always have that impression of 1, 2, 3, 4, 5 ABC, Fibonacci's and everything. But I want you to put all those impressions aside and today really just focus on the basics, essentials, and the principles of Elliott Wave. Okay, and over here you can see that the title in the PowerPoint slide is basically, we call it patterns, right? 市场的形式. So at the end of the day, you want to first be very familiar with some common patterns that you tend to see in the market. It tends to repeat itself and it has very high probability. And then only from there, you start to stack up the different layers of analysis, right? So you don't want to immediately jump into the advanced level, right? You always want to start with the most important foundation, and that's what we talk about in terms of patterns, okay? So over here, when I pull out any chart, right? If you're very new and you're not familiar with the principles of patterns, you look at this chart, we call it naked chart, okay, naked price action. You'd be totally confused, right? You'd be saying like, so what do I look out for? What is happening over here? There's nothing, right? You basically can't see anything. But for those who are trained in patterns, okay, specifically, we call it Elliott Wave patterns, you'll be able to dissect these charts into the patterns itself and you can see it with confidence and clarity. I mean, some of you who are tuning in today's probably, have been watching some of my stream quite regularly. You'll be able to then identify and exactly, what are some of the patterns that we're focusing and talking about, right? So you can see, right, this is a naked chart without any drawings onto it. Some traders will be confused, don't know what's happening. But if today I just put in some drawings over here, okay, you'll be able to then start to dissect the charts with clarity, okay? So you can see over here, if I break it down, those that I've highlighted in gray, okay, those are what we call fast momentum move, right? You can see the market actually move pretty fast in those gray areas, right? And then those that I've used the yellow lines to kind of draw certain, frame on it, those are what we call corrective move, right? So comparatively, the one that is in gray is moving faster as compared to the ones that are in the yellow box, right? The yellow frames, right? So yellow lines, you can see this slope. Okay, so this gives you a quick kind of idea, right? What we mean by pattern. Okay, we are first breaking it down to the simplest form of understanding whether the market is moving fast or moving slow. Okay, and that's what we call the pieces of the market, right? Okay, so over here in Chinese, okay, we generally have three types of market movement. Okay, one is what we call impulse. In Chinese here, it's called 推动浪, right? It's called impulse, which can indicate that the market is moving fast. Okay, now the second one is called 调整浪. 调整浪 in English is called corrective move or corrections. Okay, this usually used to describe when the market is basically slow. Okay, it's not going anywhere, it's developing very slowly. And then we have the third category, we call it 爬行式, which is a crawl pattern. Now, what's the difference between a corrective move and a crawl pattern? I'll show you in more examples as we progress. Okay, but in short, every time when you open up a chart, doesn't matter what time frame, doesn't matter what instruments you are looking at, you want to prime your mind to start looking at a chart and defining whether a move is fast or slow. Okay, we call it impulse or corrective. Okay, or you can just ask the question, fast or slow. Okay, so this here, when I highlighted in gray, those are what we call impulsive move. They move in a very fast momentum, right? Whether it's going up, it goes up fast, it comes down fast. That's what we call impulsive move. Okay, and then we have the corrective move, right? So this is what we call corrective move. It's slow. Okay, as you can see that, right? It doesn't really go much in terms of price. It's more or less like sideways, and it takes a longer time to develop. Right? Compared to what? Compared to the down move, right? So if you just focus on the right hand side here, this move down is fast. It's relatively shorter in terms of the time development as compared to this one here that is sideways. Okay. Now another thing that you observe is when we are looking at a corrective move, the market tends to be going up and down, up and down, up and down, up and down, right? Which means in terms of candlestick formation, you see alternating colors, red and white, red and white, red and white, right? But if it's an impulsive move, usually you see consecutive same colors, right? Red color here, you can see here a couple of reds, only one or two whites in between. Same thing here, right? This one here is coming down, the red candle dominates it. Okay, so that's the difference on it. Now then we also have this what we call a crawl pattern. Okay, so this is where the corrective pattern and the crawl pattern differentiates a little bit. Okay, so I'll go back to the corrective pattern. Okay, so corrective pattern you can see is after a fast drop. Okay, what we get over here is the market actually pulls back in the opposite direction, but it goes back slowly. That's what we call correction, right? So a fast drop, the market pulls back in the opposite direction, but it does slowly. That's a correction, right? Here as well. Fast drop, it pulls back in the opposite direction, but does slowly. That's a correction. Okay. Now a crawl, the nature of the movement of price is the same. The only difference, of course, is the crawl moves in the same direction of the fast move, right? So you can see this fast up, impulsive move to the upside, and then after that it slows down in the same direction. Here as well, it goes up very fast, and then it slows down in the same direction, right? So we kind of label this as a crawl. It came down, it slows down in the same direction of the impulse, right? So that's a crawl. Okay, so a crawl and a corrective, the nature of the development is the same. It's slow, there's a lot of overlapping move. Okay, the only difference is what was the prior move, right? That would determine whether we're looking at a corrective move or we're looking at a crawl. It's just different names to describe it. Okay, so why is this important? Okay, in a while we'll go into more practical examples, but this is just a teaser, right? To give you an understanding of like why is it important. Because when you be able to understand the fast move and the slow move, okay, we can then use this as a combination to identify what is the probability of the next move. Okay, And this is what we call forecasting, right? We're basically predicting, if you can call it, which direction would the market likely move in the future when we see a certain set of pattern, right? And again, these patterns are repeatedly happening in the market, and they are consistent or reliable, right? Which means that the chances of us getting it right is pretty high, okay? So this is the part where okay, it's in Chinese, right? So I'll translate that a little bit to English. Okay, the idea of trading is about forecasting what's the next move, right? There's no point looking at, oh, in the past it happened, I should have or could have done that, right? Because you won't be able to capitalize on it. But what happened in the past would actually help you to predetermine what would likely happen in the future, and as a trader you want to actually then anticipate. Okay, in the past, if this pattern always tells me there's a good chance of going up, then in the future when you see similar pattern, naturally you want to be focusing on buy, right? Because you know there's a high chance it's going to go up based on historical stats. Okay, so that's what it means, right? You want to be forecasting. Okay, so what you want to then focus on from a technical analysis methodology is to focus on a pattern that tends to repeat and a pattern that tends to have that kind of reliability that you can fall back on. Okay, so of course, I always highlight and stress, it's never going to be 100%, but if today you can have a pattern that gives you a probability of maybe about 70% accuracy, okay, that is actually a very, very powerful pattern to rely on, because you would have the confidence to say that whenever I see this pattern, there's a very, very good chance it will happen as what I would anticipate, right? Yeah, there are some times it wouldn't, but most of the time it will, right? So that's what we want to base on. Okay, so let's come back to look at some of these patterns that we just now very quickly give you some teaser, right? Now, if you take a look at this, right, whenever we have a fast move up and a crawl, we start to observe, okay, the market came down after a crawl. Okay, after an upwards crawl, the market came down. Okay, that I start to observe here as well, right? Every time we have a crawl in an upwards move, the market came down. Now, so this kind of gives me an idea that, okay, every time we see a crawl, it indicates a potential reversal. Okay, here as well, right? The market came down, we have a temporary reversal. Okay, so then I start to understand this pattern, giving me a certain probability that it may reverse, it may bounce. Okay. Then we have another pattern here, right? A fast move drop, and then we have a correction. The market continue to drop. Okay, we have a drop, we have a correction. The market continue to drop. Okay, so then again, this pattern gives me some clue. Every time we see a fast impulsive drop followed by correction, the chances of it continuing to drop is very high. Okay. And that's what I can utilize in the future, right? So this is about pattern recognition. Okay, so you can see here, right? Fast drop, correction, fast drop. Fast drop, correction, fast drop, right? So in the future, if I start to see fast drop correction, we will anticipate the fast drop. Okay, so that's what pattern recognition is. Same thing here. Fast move up, slow move, correct, crawl. Okay, so this is an impulse crawl, reversal. Okay, fast move up, a crawl, reversal. Okay, fast move down, crawl, a temporary short-term bounce. Okay, so again, the probability is that it's not 100%, but we start to get the hang of it, right? Okay. And then whenever we start to just see impulsive move, we start to observe there's not real, probability that we can really rely on, because sometimes after a fast move, it does a crawl. Sometimes after a fast move, it does another fast move. Sometimes a fast move followed by a corrective move. So what this again tells you is, if a pattern doesn't have certain reliability or consistency, then you don't trade it. Okay? You only want to focus on the pattern that tends to repeat itself and has certain sense of reliability. Okay, so with that, okay, kind of like simplify it for you, does the work for you to tell you the answer, right? So over here we have three types of category, three types of combination, or I would say three patterns. Okay. So the first pattern is impulse plus correction, right? 推动浪 plus 调整浪. Okay, so that's impulse plus correction. The second is basically impulse plus crawl. And then the third combination is basically a V shape, which means if you get after one impulse, you get another impulse, or you just see an impulse, then there's no pattern, right? It's basically don't do anything, okay? So very quick, if you see an impulse and correction, basically you want to forecast the next direction following the impulse move, okay? If you see an impulse and crawl, then basically you expect the reversal, okay, the opposite direction, okay? And if you only see impulses or you see two impulses one after another, you don't want to trade because the probability is not in your favor, okay? So this is like the most important element of Elliott wave, the most important foundation of pattern recognition, okay, that you need to be very, very comfortable with. Then you start to stack up, the advanced technique of analysis, right? But this thing here, if you can't grasp it with confidence, you can't use it with confidence, then it becomes very, very difficult for you to actually stack up your advanced technique. Okay, so this is the most important aspect of all. Okay, so how then do we apply that, right, into proper application? Okay, so whenever we look at this, right, so what we have a pattern here, we always ask, when we open up a chart, we always ask this question. What is the pattern that I can identify on the right-hand side of the chart, right? Because that's the most relevant piece of information to us. So in this example, right, we can see that we have a fast move up, we have a crawl. Okay, so this is the pattern that we can actually identify with, right? Impulse crawl. And then we can say, okay, whenever we see this pattern in the past, there's a good chance of a reversal, right? It's a rejection pattern. So naturally, we then understand, right? Price can either go up, go sideways, or come down. There's only three ways the market can move. Okay? So if you were to put a probability to this three direction, okay, I would say there's a good 60 to 70% chance it will come down, right? Because based on historical stats, it tends to come down. But it's not 100%, which means there's about 10 to 20%, okay, it will either go up or it will go sideways. But there's a good 60 to 70% chance it will come down. And naturally, the direction that I want to focus would be to look for sell, right? Okay, so over here you can see 70% will focus on the drop, 20% maybe sideways, and then 10% continue to go up, right? So about 20 to 30% it will not drop, but there's a good 70% it will drop. Okay, so as a trader, will not be focusing on the buy, will not be focusing on sideways, but will be very interested in the sell side, right? So that's what pattern can really establish in the quickest way possible, without any form of indicator, without any form of complex kind of analysis on your chart. Just by looking at the pattern, you'll be able to determine the direction first in a very, very fast way. Okay, so over here, let me cover a little bit in the understanding of forecasting. Okay, so this is what we call 预测的原则, right? The principles of forecast, right? The principle of forecast is where we always want to prepare 2 to 3 scenarios of what the market can happen. Now, this is a very important psychological aspect because if today you only prepare one scenario and the market doesn't follow what you anticipate, then you'll be thrown off guard, right? You'll be like, oh, suddenly something's happened. It doesn't go according to what I want. How now? Okay, you'll be put in a panic mode, right? Psychologically, you'll be affected. But if today, before the market even happens, you can already plan out scenario A, scenario B, scenario C, then if A doesn't happen and B happens, you will not be thrown off guard. You will not be in a surprise state, but you say, okay, A did not happen, B happened. Let's look forward again. Based on scenario B, what I've planned out, what should I be doing? Okay, so the principle of forecast basically means that you want to prepare at least 2 to 3 scenarios that can happen. Now, and in order for you to actually do that, you need to be very, very familiar with patterns, and you need to kind of like tune your mindset into thinking in terms of probability and not certainty, right? Okay, so over here is what we say, at least have a plan B. Okay, so how can we use that simple patterns to help us in our forecasting principle? How can it help us to prepare for our scenario B? Okay, because we understand patterns so well, okay, we know that in the market there are only a couple of few ways the market can develop. Okay, because if we break it down to the core, to kind of like the essence of it, we understand that there's only a couple of ways the market can develop. Okay, it can either go up in a very fast manner, okay, Okay, over here we call 上涨推动浪, which means it's an impulsive up move. It goes up in a very, very fast state, or it can come down in a very fast state, right? So of course the direction can be up and down, and the movement of it is fast. Okay, now if it's not fast, then naturally it will be slow. Okay, so if it's slow, it either can be a sloping upward slow move or a sideways move, or it can be a sideways move and it's a sloping downwards move. Okay, there are only these four moves in the market: up fast, down fast, sideways, whether is it sloping up or sideways sloping down. Okay, now you can't find the fifth one, right? Because if the market is not going up or down fast, then it's slow. And if it's slow, it's either going up slow, down slow, or sideways slow, right? So when you really understand this principle, okay, think of it as a puzzle itself. Now you have 5 pieces or 4 pieces in your hand, okay? And then whenever you look at the chart, you're basically just putting these pieces in, right? Let me give you an example. Now when we look at this chart here again, right, we can then understand on our head, we only have 4 pieces: up fast, down fast, sideways, slanting up, or sideways slanting down. Okay, so of course we understand this pattern here is a crawl. So of course our first scenario, our primary forecast will be expecting the market to come down fast, right? Because this pattern has 60 to 70% chance of this happening. Okay, so we'll be expecting that. Okay, now suppose this doesn't happen, right? So the market, if doesn't come down very fast, what are the next likelihood it can develop into? Okay, so just now we have 4 P's, right? If it's not fast down, then the next move will be maybe slow. Okay, so maybe this. Okay, so that becomes our what? Second scenario, right? And if it doesn't come down slow, what can it develop? Maybe it can continue to go up slow, right? So if it continue to go up slow, then it's just an extension of a crawl. Okay, so I don't have that. Now, if it's not going up slow, it's not coming down slow, it's not coming down fast, then the only way the market can after that develop is a fast move up. Okay, in this case here, fast up. Okay, there's no other way the market can develop, right? So with that, what we have essentially done is we have prepared ourselves in all potential scenario where the market can eventually develop, and we won't be panicked. Okay, because we know, right, if scenario 1 happens, how are we gonna look at the trade? If scenario 2 happens, how are we gonna look at the trade? If scenario 3 happens, what are we gonna do? Okay, we can always pre-plan way ahead before the market even develop. That's really the beauty of Elliott wave, okay? And that's really the beauty of really understanding the principles of patterns, right? So of course, we're focusing on down. There's a high probability of this happening. If this is our scenario, then we'll be having a sell trade, right? Because that's what we want, essentially. But if we start to see the market doesn't really come down fast, it starts to come down slow, we then update our analysis and we say maybe we're not interested in the sell anymore because this pattern doesn't really tell us more downside. It's actually a pattern to tell us more upside. Okay, so we shift, right? Very quickly we can update our analysis, we can shift, we can pivot from selling to maybe look for buy. Okay, and if let's say we start to see a fast move up, then obviously this is a no trade. Okay, because just like I mentioned, if you just see an impulsive move, we don't touch it, we don't execute any trade, we give it time to develop first, right? So again, you will not be thrown in a surprise, right? Because it doesn't matter what the market does, you already can prepare way ahead. Okay, so that's the beauty of forecasting. Now, I'll give you a little bit more example over here, right? We have a fast move down. So obviously we don't trade it now. Okay, but what we can do is we can prepare ahead. Okay, so we will again coming back, we only have 4 P's. Slow move to the upside, slow move to the downside, fast move up, fast move down. Okay, now if this is already a fast move down, if this just continues moving down fast, it's just an extension of the move to the downside, right? So we just look at it as one piece to the downside. Okay, so we usually don't forecast that, right? So we only have 3 other scenarios. 1, we have a fast move up. So this is a V shape, right? If you can't get a fast move up, you don't move, no trade. Okay, this is the first scenario now. Second scenario, we get a sideways corrective move, which is slow, sideways, slanting to the upside. Now then in this case, we have a potential trade, right? Why? Because this pattern tells us there's a good chance of downside. Okay, so we have a potential trade, we can look for it. Okay, when the market gives us this, we can start to prepare. Now the last scenario in which the market can potentially develop is a slow move down. Now, if this is a slow move down, then we have a crawl. We have an impulse, we have a crawl, we'll be focusing on a reversal. Okay. So again, you realize what we're doing is we are taking simple pattern on how the market can develop and then put in the principle of forecasting as a scenario planning, okay, to help us look for potential trades, right? Without any complex indicator or complex technique or strategy. This is just the simplest form of things, right? Look at pattern. Of course, the more you add on in terms of the layers like Fibonacci's, some expectation principles and things like that, those are a little bit more advanced, but when you start to add those in, it helps to increase a little bit of clarity and probability. But for now, the basics is the important aspect. Okay. So over here, let me jump over to some charts example first. Okay, and then we'll come back to a little bit in terms of Fibonacci's. Okay. Now use a little bit on gold chart. Okay. Now let's take a look at here. Okay. Apply that simple principles. Okay. You always ask yourself this question. Okay. What is price doing here? Okay. Now this is a 4-hour chart, right? Because I primarily look at 4-hour, but you can apply this same principle, similar principle on any other time frame. Okay. So if you take a look at this, right, on the 4-hour chart, what the market is doing recently is going sideways. Okay. Within it, of course, there are movement, but from a larger scheme of things, it's just basically going sideways. It's really taking some time to develop. It doesn't really go up. It doesn't really come down. There's no new high. There's no new low yet. Okay. So that's how we define as a corrective move. It's chopping sideways. Compared to what? Compared to this move up, right? You can see fast up, slow move. Okay. So what does it mean? This means that we have a pattern of an impulse and potentially a correction. Okay. And this tells us that after a correction, there's a high probability we may continue to see upside. So far can follow, right? Now then, if we go down to the hourly, okay, what do we see on the hourly? We see a very fast drop as of now. Okay, so what we do now, we don't trade because this is just a very fast impulsive move. But we can start to prepare, right? We can start to forecast. Now, if this just continue to drop, then nothing, right? It's still basically one move. But if the market starts to pull back and form a corrective move like that, we have a pattern, right? This is an impulse correction. We expect downside. Okay. Now, if this starts to then form a crawl, okay, then we know this would likely start to bounce. Okay. Now, if for some reason the market just decides to U-turn and do a very strong back push up, like a V, then obviously there's no trade. Okay. So you can see based on just simple principle like that, we can start to forecast. Obviously, this is no trade. You don't jump into the sell now. Okay. Now, in fact, on a higher time frame, you can combine with a lower time frame. Right? On a higher time frame, we are seeing what? We're seeing a little bit of a sideways move here. Okay, which means higher time frame potentially, may tell us focus on the upside because of the impulse correction. But on the lower time frame, we only get a fast drop. Okay, so you can actually play around the principle of multi-time frame. Higher time frame says up, lower time frame says no buy yet. So wait. Okay, so you want to have some kind of an alignment. Now, what I mean by that is if the hourly starts to give you a crawl, okay, so this crawl pattern has a good chance of a reversal. So on the hourly, it starts to suggest look for the buy. And then on the 4-hour time frame, you have this correction. Also look for the buy. That's where your probability stacks up. Okay, so this is something you can use to apply, right? Not only on gold, okay, you can actually apply it into other currency pairs as well. Let's say Australia dollar, right? Australia dollar has a pattern. Okay, give it some time, it's loading. Now, if you have any questions, feel free to put it into the chat box. I'll look at those questions and, of course, answer them along the way, right? Okay, this is obviously not loading. Let me just get out and come back in. Okay. it's working now. Okay, where's my charts on TradingView? Okay, it's back up. Okay, so over here, you can see in terms of pattern, right? We have a fast drop. So far, we're seeing a little bit of a corrective pullback. Okay, so this kind of suggests that there's a good chance Aussie dollar would likely come down. Okay, so I don't really need to look at what happened in the past for now, but I can just focus on what's happening recently to help me determine the direction I want to focus on, right? So dollar Canadian is the same. You have a fast drop here. This is actually doing a little bit of a correction. So this combination of an impulse correction suggests there's a good chance we'll look at the downside. Okay, so that's how you actually focus on the direction, right? Just based on simple patterns. Okay, so I hope so far so good, yeah? So over here, we'll add in a little bit of a FIP confluence. Okay. Okay, so Yusuf had a question, right? How do we know whether the impulsive is a reversal or just a correction? So if, very good question, right? If you only see an impulse move, like gold, okay, on the hourly, okay, if you only see an impulse move, we won't know for sure yet whether is it going to be a reversal or not, right? I mean, at this point in time, you won't know whether this is going to reverse or is this going to continue, okay? So that's the very reason why whenever we see a fast drop or a fast move up, at that point in time, we don't want to be trading it yet, okay? You always want to wait for the next move. After a fast move, wait for the market to tell you what's next. Now, if this continues to drop very fast, still nothing. Okay, even if it breaks it, doesn't mean you want to sell. Why? Because what can happen over here is it can break this low, and the next thing it can do is it can do a V-shape back up. Okay, so you don't want to jump into the sell yet. You don't want to buy either, right? Because what can happen over here is it can keep breaking. You never know when it's gonna stop. So every time you see a fast move, just be patient. Okay. So for Yusuf's question, right, we'll never know whether is it gonna reverse or it's just gonna continue dropping. But you don't need to, because you just wait. You wait for the market to tell you what's going to develop next. Okay. If it's a correction, likely a continuation down, right? If it's a crawl, likely a reversal back up. Okay. So that's quite straightforward. Okay. So now if we want to add in a little bit of elements of fits, right? Can we do that? Okay. So the answer over here is, once you understand the basic patterns, the combination of that, you can add another layer of Fibonacci analysis to it. Okay, so Fibonacci over here, we have two types, right? We have the retracement tool, and then we have the extension. Okay, so retracement that we commonly use includes 50, 618, 786. The extension in Elliott wave that we commonly use is 61.8, 100%, 123.6, and 1618. Okay, so very quickly, retracement, basically we are measuring the pullback. Okay, so most of the time we expect the pullback to come towards 50 and 618, and we would expect the price to maintain above 786, right? So in this case here, you can see the impulse move is up. We'll take from swing low to swing high. The 50 and 618 Fibonacci is there. We'll expect the pullback to be supported around 50 and 618, especially if this pullback is corrective in nature. Okay. So we don't just pull the fits and then just trade off the levels. Okay, we want to also confluence it with the principle of correction, right? Fast and slow. Okay, same thing here. Fast move drop. If this develop correctively towards the 50 and 618, then ideal we have an impulse correction. Right? We don't just trade off the 50 and 618 all the time, right? We want to combine it with patterns. Okay, those are very important. So fit retracement, we are looking at around 50 and 618 as our entry area, combining it with a corrective structure. 786 as a potential kind of stop loss, right? Invalidation level. Okay. And the idea is, if the market breaks above 786, likely it's not looking very corrective, right? That's the reason why we put an invalidation level there. Okay, so let me very quickly give you some examples of it. Okay. So suppose this here is an impulse move, right? Simple example, right? We just pull FIPS, okay? There's a good chance around 50 and 618 will be an area that we can look for some support and becomes an area of entry. Okay, but it doesn't mean that you want to just get in every time it hits 50 and 6.8. Okay, you want to find some kind of confluence where this likely would start to slow down. From a crawl here, then you have that pattern, right? So you look for confluences, you look for combination of things, right? Aussie dollar, for example. Every time I go to Aussie dollar, it lags. Okay, so Aussie dollar, for example, if you take swing high to swing low, you can see here 50 to 618 area tend to get a very nice little reaction. And of course, in this case here, we have a very nice little corrective structure too. Okay, dollar Canadian, okay, you can also same thing apply 50% to 618. Okay, it came quite close, but of course, if this continue to go up around the zone, that will be an area of interest to get in on the sell because this is corrective in nature, right? Okay, so that's what we meant, okay, for 50 and 60%. Okay, you don't want to just blindly use it, but you combine it with the principle of correction. Okay. So use of follow-up question is how far can wave C go? Again, based on simple 50 to 618, usually around that zone. Okay, around 50 to 618 Fibonacci areas. Those are where the wave would probably end. Okay. Now, the other way to look at fibs, right, is you use the expansion tool. Okay, so expansion tool over here, we can also use this as a form of take profit. Okay, and at the same time, we can also use expansion tool as a form of entry. Okay, so over here, you can see we have an impulsive move. Okay, and we'll start to seeing this as a correction, right? Very obvious. This is fast, this is slow. And we can start to apply Fibonacci expansion, right? So Fibonacci expansion, we need at least 3 points. Okay, A, B, and C. C points, right? These are not wave labeled. These are point A, point B, point C. So basically, to use the Fibonacci expansion tool, you need 3 points. Okay, your first point is point A, point B, and then point C. You're basically measuring where this is, right? And we'll always look out for areas around the 100% and 1, 2, 3. Okay, this is the area of entry, and then 1618 becomes an area of invalidation. Okay. And then of course, you can also use the expansion tool as your target by looking at a slightly different structure. So this one here you can see, right? Fast move, correction. Would expect this to continue to go up, and then where would it likely go? Somewhere around 100%. Okay, so this is what we call an equal leg. Okay. So let me show you an example. Okay, now coming back to the chart, if you use go, okay, now if this is coming down as a corrective structure relative to this fast move, okay, so we can use again what? We can use the expansion tool, point A, point B, point C, 100% and 1, 2, 3. Okay, so we are basically tagging that level right now, right? So what it means is that this area here is a potential entry zone. Okay, 1618 becomes a potential invalidation zone. Okay, so the idea is what we want is for price to continue to respect this area and start to see some bounce, right? Or at least starts to slow down and form a crawl here. That would be an area of entry, right? You wouldn't want price to break that 1618 because if price continue to come down at 1618, this is no longer a correction. Why? Because this move is fast, right? So again, fall back to the basic principle, impulse correction. Okay, the fibs are additional layer to that analysis. Okay, so that's one. Okay, if you take a look at like Aussie dollar, okay, the relationship of this little move here, I think on the hourly is a bit clearer. Okay, from here to here to here, okay, you can see 100 to 1, 2, 3. Most of the time, that's where you're gonna react. Okay. Now, can we use this tool to help us identify where would price likely go? The answer is yes too, right? You just take from high, point A, point B, point C. Okay. So what we would expect is from here on, it may start to continue to move towards this area, kind of like this move here, right? So you have an impulse, correction, impulse. Okay, this becomes the next area of target. Okay, same thing here in dollar Canadian example. If you take this from point A, point B, point C, Okay, then we'll expect for the market to maybe come back up a little bit correctively towards the zone. You expect some kind of a rejection, and price needs to ideally stay below that level. Okay, so then what you get is an impulse, correction, impulse, right? So far so good, yeah? Chair asks how to determine the expansion percentage of 618, 100%, and 1618. Yeah, so basically this is the tool that helps you to automatically calculate. Okay, so if you are using the FIB tools for measurement of a, okay, let this load a little bit. Okay, if you are using it for measurement of a corrective move, okay, which means we are anticipating this to form a correction, you can calculate, where this correction would likely end. Okay, then you need to use it from the point of starting point of the correction to the second point and then to the third point, right? So that's how you determine this 100%. It's automatically calculated. Okay, I seldom put in the 618 here, okay, but I just focus on the 100 and 123. Okay, so that's how you use. Most of the time I would like to just put in a little bit of a channel as well to give me my visual aspect, okay, to tell me that, oh, this looks corrective, right? Same thing here on Aussie dollar. This here I can put in a little bit of a trend line. It looks corrective. Okay. Dollar CAD as well. Okay, I can put in a little bit of a trend line here so that looks corrective, right? Okay, something like that. Okay. Now, do I need to label the charts? Technically you don't, okay, because if you are just, okay, the labeling essentially is just to communicate the idea, right? But again, I can strip away the label. The analysis still stands. Okay. Yeah, so this one here is basically using the FIBs to measure the correction itself. Now, if you want to use the extension to measure a target, then what you do is slightly different, right? This is an impulse, this is a correction, and you expect this to drop, and you want to look for areas to target. Then you use the tool slightly different, right? You use it from the start of the impulse to the end of the impulse to the end of the correction to put the target. Okay, so this tool is very, very flexible, right? Depending on, are you using it to measure the correction itself, or are you using this Fibonacci tools to measure the targets? Okay, yeah, so that's the difference. Okay, so to give you some examples, right? Let's put in a in-depth analysis on gold. Okay. Now what we'll do is we'll look at 4-hour to hourly, right? That's usually the two time frames I like to focus on. Okay. Now whenever we start on a empty chart, okay, especially on a 4-hour, right? How many data points do we need? How do I need to look all the way back in March 2022? Is that relevant to me on a 4-hour scale? Just a guideline. Usually on a 4-hour chart, you just need about like 3 months worth of data. So we're basically end of July, right? So we have July, June, and May, right? So you basically just need data points somewhere around from May. Like here, you can see this is 4th of May. Okay? So this scale is good. Okay, so you just need to have a rough estimate of the scale. Okay, so in this case here, right, I always like to start off with obvious high and low. Okay, so this is a low point. So far, this is the highest point that we're working on relative to where we are. Of course, that is highest in this scale, but we just like to focus here, right? And then what I like to look next is always ask this question: how is price developing? Is there an obvious pattern that I can identify, right? In this case here, we do have relatively a fast move and a slow move so far. Okay, so my primary forecast would jump to the pattern of an impulse correction, and then we'll look for upside, at least from a 4-hour time frame perspective. Okay, we'll focus on the upside, right? So that's the 4-hour chart. Okay, then I can add in a little bit of a layer in terms of, okay, this one here I can draw in a little bit. Okay, I can put in a little bit of a fibs, right, where we can see just now we're kind of currently reacting around that 100%. Okay, So this is what I get so far on the 4-hour time frame. Okay, we're already in the area, right? But of course, this drop is pretty impulsive, right? So the question is, do I just jump in and buy it? Probably not, right? So then you can actually combine it with a lower time frame. Okay, whatever you've done on a higher time frame is there. Now on the lower time frame, I want to wait for certain sign of confirmation, right? What this means is that, again, back to understanding the pattern. The market can either go up fast, go up slow, come down slow, or go down fast, right? These are the only 4 pieces, right? Of course, sideways as well. Okay, these are the only couple of pieces in which the market can develop. Okay, so let's just take example, right? If today the market just does a V-shaped bounce, do I trade at that level? No. I would want to wait for at least some kind of a corrective pullback. Then I trade the next move up and follow that thought process, right? Because why? This is a pattern that has high probability. This is a pattern that doesn't really have a high probability. Yeah. You can see what I'm doing, right? I'm just having these few pieces, I play around with it. That's called forecasting. Now, if the market eventually does something like that, I wouldn't be buying. Okay? Because why? This pattern tells me there's a good chance this will come down. Would I sell it? Probably. But again, I would combine with a higher time frame analysis, right? So maybe I will avoid this sell and just observe, right? But if this happens, I won't buy for sure. Okay. Now what happens if I get this? Oh, this is a good pattern, right? Why? Because impulse, crawl, we know there's a high probability of an upside. This is a pattern that I'll be interested to buy because the higher time frame agrees with the direction, right? So we can't get a confluence. Okay. Now what happens if I get a sideways chop? This here and this here is more or less the equal thing, right? Basically, they are sideways, they're corrective. The probability is still down. Okay. So either of this, whether it's slanting up or sideways, I won't touch it. Okay. So you can see what I've done, right? I basically have these 5 pieces, which is generally what the market can do. And now I just mix and match, right? Because I understand how patterns play out. Okay, and that's what I really want you guys to take away from today's live session over here. Okay, now if the market just continue to drop, then you just see it as one impulse, right? Then you continue that part here. But of course, if it breaks through all this fibs and all this channel, you don't anticipate that it will react to the upside from here, right? The chances of this bouncing back up is not very high. So if this is the case, another follow through very strong all the way breaking all this to the downside, then you just wait for a correction, you take the next trade down and follow, right? So it's always back to all these pieces that you can always get in the market. It's always there, right? So look at this here, right? What can you fit in? You fit in a fast move here, you fit in a crawl here. Can see that, right? Okay, and then what can you fit in over here? You fit in a fast move here, you fit in a crawl here. Okay, the pattern repeats, right? You fit in a fast move here, you fit in a correction here. Okay, it's not like exactly the same, but you get a hang of it. Okay, of course, it's not going to be always so nice, right? How do you determine this? Not the best, not the clearest, right? So what do you do when you observe something like this that you can't really determine it? You just wait, okay? You don't move, right? Yeah, so this here are what we call V-shape formation. Okay, just to illustrate some example of a V-shape. Can see that, right? I mean, this here is a V, right? Can see that. This one here, I would label it as a V as well, right? A very fast drop and then it just bounces back up. Okay, this one here is technically a V as well, right? So very fast up, very fast down. Okay, then this one here is also technically a V, very fast down, very fast up. Okay, so again, these are basic pieces that the market tends to develop, and again, I want to stress, right? It may seem simple, okay, but it's actually one of the most important foundation for you to take Elliott wave to the next level. And even if you don't do labeling, you don't do complex stuff, this simple principle can actually guide you a lot, okay, in terms of forecasting, in terms of preparing, what's going to happen next, in terms of preparing for your trade plan, in terms of like helping your psychology in adapting to what the market can actually develop. Okay, so I hope so far so good. Okay. Yeah, so we do have ECB today, right? That's why you kind of see some volatility coming in. Quite a bit of all this move right now seems pretty impulsive, so you may not want to just jump in. Okay, but naturally what you can do, of course, you can take what we've covered today, practice it, right? And then of course start applying it in the future, right? Like crude oil. This is so obvious, the pattern. Okay, you don't want to be focusing on buy, but instead focus on the sell, right? So again, how do you execute a trade? There are many ways. Some traders look at like engulfing bearish and then they will just jump in the sell because the pattern confluence that. Some traders will look for breakout, right? So maybe you go down to a lower time frame, identify certain key lows to execute your sell. Okay, some traders will look at engulfing, as I mentioned. You can combine it with maybe double top structure. Some traders may be a little bit more conservative. You wait for the break of the neckline, retest, then only sell it. There's a lot of ways to get involved in the trade, but this here gives you the indication on focusing on the sell instead of the buy, right? How you sell it, there are many ways to actually get involved in the trade. Okay, so I hope that kind of give you that clarity. Yeah, so far so good, huh? Good. So with that, I'll do a quick closing note, and we'll see if you guys do have a couple of questions, we can answer them. Okay. If not, then hopefully with the entire session over here, you actually take away something. Okay. So for today, this entire live stream, okay, initially is in Chinese, then we converted it to English. This entire live stream is actually sponsored by Monatsa. Okay, so if you want to understand a little bit more about Monatsa, you can just Google it, go to their website, understand that. Okay, but because today you guys join in today's live stream, okay, they do provide with a special bonus, a promotion, okay, which means that today you register for your account using this link. Okay, of course, because it's online, okay, I'll put in a QR code. So what you need to do is just scan this QR code. It'll direct you to the link. Just register for your account, okay, with Monatsa, right? So basically it's your trading account. It's free to register. And then of course a simple process, get your account verified, submit your KYC, and then once you've done all those, a representative from Monatsa will actually get in touch with you to guide you on the processes. And because you registered via this link and you attended today's live session, you'll be able to get a 100% credit deposit bonus, right? So what this means is if today you fund your account with, let's say, $500, using this promotion over here, you actually get an additional $500 as a credit, where you can then have a total $1,000 to actually trade the market. Okay, so the credit bonus, obviously you can't just withdraw it out, okay, but you can actually use this credit bonus as margin to support your trading. Okay, so basically means that you have a bigger capital size to actually execute trades in the market. Okay, so if you put in $100, then it's 100%. So you basically get another $100. If you put $200, then you get another $200, right? So that's how it works. Okay, so I hope that's clear. Okay, so again, you need to just scan this. It will lead you to the website, and then you just register for a free account over there. And then a representative from Monatsa will actually reach out to you to support you in terms of the steps to actually get this promotion. Okay, so today's webinar, again, usually I don't run such in-depth session, but because today is actually sponsored by them, so you guys are able to enjoy this content over here. Okay, good. So Yusuf has a question. How do you know if a broker is legit? I think couple of simple conditions and criteria to really check with, right? Of course, one of the basic form of regulation is every broker will need to go through a KYC process, right? KYC actually stands for Know Your Client. And the process basically revolves around first, when you open your account, okay, of course, you need to open up with your real name, okay, according to your identification card IC, right? And when you apply for your KYC, which means you submit the documents to prove your identity. Usually people use IC or passport, or driving license. The name needs to match, right? So that's the first layer, okay? And of course, you need to have your proof of address as well. Okay? And then of course, the second layer of KYC is that if today you open your trading account, okay, only you and you yourself are able to do any kind of a fund transfer, right? This includes deposit and withdrawal. Okay, not your next of kin, not your family members, but only you, which means that the funds that you use to deposit into your trading account needs to come from your name, right? Whether you're using a debit credit card, the card needs to have your name. If you're using fund transfer, bank, that bank needs to have your name. Okay, of course, if it's a shared bank account, it has both names, it's fine, right? Basically, it needs to at least have your name in it, right? And then, of course, nowadays we do have like crypto USDT options available and things like that. That's a little bit tricky, okay? But some KYC require you to take some videos of yourself, with identification to prove that that crypto account wallet is actually yours, right? So these are just some basic common practices of KYC and AML, right? AML stands for anti-money laundering. Okay, and of course, you can always directly reach out to brokers, like Monaxa over here with their client representative support team. You can actually reach out to them and ask them any questions that you have with regards to them. You want to find out a bit more. That's something you can do as well. Okay, so I hope that gives you some ideas in terms of what are some of the basic requirements for you to make sure that at least they are proper. Good. Okay, so yeah, with that, I just realized that my webcam is blocking the QR code. I'm not sure if you guys managed to scan it. But yeah, I just move it to the left so that the entire QR code is complete. Okay. So just a quick closing. I hope today's session has been insightful for you, okay, especially for those of you who are fairly new to Elliott Wave. I hope it gives you a different perspective of how you can approach the principle of Elliott Wave and actually use it in a more practical aspect of application. And of course, for those of you who are already, quite familiar with the concepts, we have heard countless times of my sharing. Hopefully it's a very good recap for you guys as well, okay, because no harm, always good to do a little bit of refresher so that you know what's more important. Not really the fanciful stuff of labeling and stuff, but it's really back to the principle of impulse and correction, right? Okay, and of course, for those of you who like to capitalize on this opportunity, on this promotion, okay, offered by Monaxa, you just need to scan this QR code, okay, register for your free account, go through your KYC. Again, once you register for an account, a representative from them will actually contact and reach out to you for support, right? To guide you through the process. And once you've done that, everything else, when you're ready to deposit, then you actually can use the promotion of $100 deposit bonus. Okay, so that's all from me. All the best for you guys in trading. Hopefully, again, as I mentioned, today's session has been helpful, giving you some insights. But at the end of the day, okay, knowledge is one thing. To really internalize those information that we have went through today, you need to practice. Okay, you need to obviously put in the time, put in the effort to look at the charts, okay, to apply on the charts. Okay, yeah, so that's all from me. Okay, so good. All the best to your trading, all the best to your trading journey as well. If we have the chance and opportunity, hopefully can see you guys again in the future. Okay, and that's all for me, right? So see you guys. Bye.